Dave@DaveLandry.com. All right, let's talk about the mystery charts and the methodology in action. Here's our first mystery chart. And there's the parameters down below. This is a screenshot directly from my trading service. And by the way, for my international clients, I started putting them up on YouTube, and I scheduled them to go delayed for several days to a week, depending on where the setups are and whether they're triggered or not. So you can find those now on YouTube, youtube.com/Dave Landry. You could also find the archives at davelandry.com/archives, and it's a great exercise, if I say so myself, going in and looking at what I saw without any foresight, obviously, and without any hindsight, I should say. And now things worked out good, bad, and indifferent, warts and all. Very important to see the good and the bad when it comes to methodology. Anyway, those are the parameters. You can see this stock made all-time highs and then began to sell off fairly hard and just pull back a little bit. With a transitional setup, meaning you're getting in as an early new trend is developing, and ideally an old trend is ending and a new trend is developing, you want to take those off of all-time highs. So you want the bow tie or the first thrust or whatever the pattern may be coming off of those all-time highs. And the reason is everybody is happy at all-time highs and everybody's feeling pretty good about the stock. But the Johnny-come-latelys, those who bought the high ticket here, as soon as the market begins to come off a little bit, they tend to be the traders with the less, they're more fickle traders. They're more FOMO oriented, and then they become quite panicky fairly quickly. That's one reason why I like the TKO is such a great pattern. But anyway, when a stock begins to fail like this, or any other market for that matter, these guys can be quick to rush to the door. Now, a lot of people, it's a psychological thing, but a lot of people don't sell a market while it's headed lower. They wait for it to bounce back, and that's why these pullback type of patterns work. And with a transitional pattern, sometimes you wait for just a one bar pullback, and the reason is because if it turns right back down, those people who wanted to get off the hook quickly rush in to get out the hook a lot of times, and then the market implodes. Anyway, so there's the entry. The initial profit target is down here, and the stop is up here. Initial profit target would take half of the shares off, and we move the stop to break even. I think I have a live example of that. I do. In 1 second. All right, here's the second mystery chart. There's the parameters again down below. Entry. I'm sorry, before we do that, notice that it formed a major double top. Now, I don't trade directly off of classical technical analysis patterns. I would recommend you read Schaubach, Edwards and McGee, and who else? More modern would be Pring. Pring's a nice guy. I met him at a Stock Charts conference a couple years ago. Super nice guy. He liked my my trend following instructions that I have printed on my arm. But anyway, do learn about all this classical technical analysis. Just don't try to put it to work right away and all the time and all of it. But what you can do is use it as sort of a backstop, so to speak, to your patterns that you're using. Okay. So say you have a bow tie, then it's nice to have maybe a major double top working with that bow tie, or a big cup and handle pattern with a bow tie at lows or pullback or whatever the case may be. But anyway, I made the double top, and you can see the bow tie moving averages did come together and spread out. And I'm going to talk a little bit more about the bow ties in just 1 second. But anyway, I did form a bow tie to the downside. Now, technically, that bow tie would have triggered right there, just for those keeping score. But you can see the market did begin to roll over, and now it's begun to pull back. Entries here, stop is up here, initial profit target is down here. A couple of weeks ago, and last week, I followed up on this buy at B setup. We were talking about this in the Facebook group, and I would say 95% at least, or maybe 98% of everything I show you here was either directly from my trading service or we talked about it in the Facebook group. So I don't want anything to be like, oh, you just cherry picked that one. And every now and then I do show a losing trade in here too, by the way. Anyway, the buy at B would have been here. Without going through a lot of details, buy at B, you buy at a new closing high on any day from day 5 and beyond. So day 5 would be, let's say a stock comes public on Monday, day 5, Friday, obviously, if it closes at a new closing high, now you have to anticipate a little bit, obviously, then it would be a buy. The only caveat, well, there's a couple of caveats. One, you want to make sure there's plenty of range in the market, obviously enough volume. There's a few other things we're looking for too, such as with a pioneer setup like this, meaning that you're getting in early. You also want to make sure that's what's the story, fad, or glory. There's some sort of excitement around the stock that could possibly propel it higher before taking these pioneer type of setups. But anyway, when day 1 sets the high for the week, let's just say one of these days would have been higher than day 1, then you go off a closing high. But when day 1 sets a high for the week, it has to also close above that high. So technically, the buy at B buy would have been right here, but it kind of barely triggered. And I like that it began to form an expansion of range. So I ended up buying the following day, kind of a buy at B +1 when that occurs. And that's where you use a little discretion. If it just kind of barely triggers, you need to think twice whether or not you want to get in on that position. But anyway, stop was down here, 2 points below, which gave us a 2-point initial profit target. And we did hit that. And then you sell half and you move the stop up to break even when that occurs. Unfortunately, there was a trading halt. This thing began to implode, and I was trying to exit, didn't realize it was halted. And then when it opened up again, I tried to exit again, and it's like my market order got stuck in Never Land when this thing was halted a second time. Wouldn't let me cancel it, wouldn't give me a fill, but it happens, okay? So this is how it all worked out. Ended up losing money on the second loaf, but overall made $281, better than poking the eye. This was a small position I took. I don't know why I took a small position. I'm trying to think why. I guess it just wasn't a very exciting position. The range, let me see, what was the range? What was the reasoning for that? I forget exactly. Yeah, the range was pretty good. A little lower price. I'm a little more skeptical with those. Maybe that's what it was. But I felt like it was worthy of taking the setup. Anyway, so $281, you know, better than poking the eye. But yeah, sometimes, well, all the time with trend trading, the trades do eventually end badly, but hopefully not this badly. And the reason we're hanging on that second loaf is just in case it turns into the mother of all trends. So I'm out. I was out there at 770, actually out less than I bought it for. So again, losing trade on that. But overall, if you count everything up, turned out okay. All right, so we're done with that. All right, any questions on the buy at B? I know I kind of rushed through it. We've go in and watch last week's presentation where I did the walkthrough, and I even get a little tripped up with the day 1 rule. So if day 1 sets the high for the week, then it also has to close above that high. And then as I alluded to earlier, there's a couple of caveats. Usually I don't take trades below $5 a share and above 30, the $30 rule, which used to be the $20 rule for those keeping score. All right, let's talk about timing and trading with the VIX. So just to rehash real quick, the funny looking chart up top, I don't know what you call those charts, but funny looking chart is the VIX. And I have the S&P 500 overlaid on a closing basis. And this is a 10-day simple moving average. Without going through a lot of details, many years ago, I worked with Larry Connors, and I was doing programming and research for him. He really dug that I knew how to program trading systems, and I also knew a little bit about the markets. And when he would tell me that the VIX was a reversion to the mean type of market and explain that to me, I took that literally, and he was using some other metrics, and I decided to use a moving average to do a lot of research around the moving average. And that's how I came up with these VIX systems, which we both publish in our separate books. But anyway, I'll mention this in just 1 second, or I'll just mention it now. The short-term VIX stuff absolutely prints money, but there is a caveat. Every now and then it blows up a little. And I kind of feel that way about short-term trading in general, pure short-term trading, okay? Day trading is one thing. That's intraday stuff, which is a lot harder than it looks, I found out. position trading, you're holding positions longer term, okay? And with the swing trading, I think the pure swing trading, it's hard to make that work longer term because you can only make so much money over a short period of time. And occasionally you will get whacked. And I remember I got whacked on one not that long ago, and maybe it was a while back, but it seemed pretty very painful. It was like 90% overnight. So it happens. I'll probably demonetize later anyway. So shit happens, right? But anyway, the VIX stuff, as I was saying, it kind of prints money. And I went back a while back and I was looking at how it just absolutely printed money for, and this, I think it was using, looking at, I forget which one, a CVR3 modified or something like that. And it was absolutely printing money. Unfortunately, this thing called the pandemic came along and it kind of blew up when that happened because the VIX got stretched and kept on stretching. And that's one thing, as I'll mention again this week, is you do want that reversion to the mean move to start. You don't want to just buy because it's high or sell it because it's low, whatever. Anyway, so these indicators down below, and you can actually see the formulas right here, okay? Looks like one of those internet things where you got to do the math problem, which is stupid. But anyway, this is the high, the low, and the close. The high is in green, the low is in red, and the close is in cyan. And close is what we focus on for these VIX-related systems. However, these highs and lows can be kind of interesting in and of themselves, and possibly can be something that could be used for some sort of intraday type of trade. But you can see when you have a really big spike in the VIX away from the moving average, okay, in this case the close was well up here, like 100% away, the market tends to have a reversal shortly thereafter. Now you can see right here, this is a huge spike in the VIX, and then right there you can see the market had sold off really, really hard. The VIX is a measurement of how expensive the options are. It's a volatility of the options, which measures how expensive they are, the implied volatility. It's a hypothetical number, and it's a formula that's freaking huge, but just know that it measures how expensive options are. Excuse me, I've got some lots of pollen in the air, which never bothered me when I was younger. Anyway, so it's measuring the volatility of the at-the-money options. Look at 30 days out, and it measures both calls and puts. And people think it's just puts, but no, it's calls and puts. And what happens is when the market gets kind of crazy, the prices of these options skyrockets. Okay, so let's say you sell an option. It's like, oh, you want me to sell you an option where I have unlimited potential losses, okay? And I can only make so much on the trade. You know what? I'm gonna charge you so much for that option. There's a snowball's chance in hell that option will ever go in the money, and I'll be able to make some money. So that's kind of what happens there. There's just a panic, supply and demand. Everybody wants them, and the market maker just marks them up. But you can see when you have those spikes in the VIX, it tends to be followed by a bottom in the market, and also because the VIX is tradable, you can trade the VIX outright with these type of patterns. Now, keep in mind, it's not a one-for-one relationship or a direct relationship or a completely inverse relationship, is I guess would be the technical way of looking at it. And it only matters when it matters, and that's something that I often preach. But notice in this case, it did take a couple of days for this market to bottom out, and then the VIX, for the most part, was imploding during that period. So here's another one you can see, big spike in the VIX here. Now, if you look down below, there was a huge spike intraday, and then the close of the VIX was still, even though it closed way down here, it was still like 100% away from that moving average, and that's very significant. And you can see the market did bottom over the next couple of days after that happened. Now, again, I don't recommend you rush out and buy the market, but maybe on an intraday basis, when it gets stretched one way or the other, pay attention to see if there's something you could do on an intraday trend trade. So again, we have a spike. And by the way, my metric here, my lines are 10%, okay? So 10% above the VIX on a closing basis, suggest a bit of a panicky mode and the market's due to bottom. Suggest now, okay? And 10% below suggests that the market has become complacent. And as I'll reiterate in 1 second, with the VIX, everything is relative, okay? I'm not gonna make what's that joke? It's like incest, everything's relative. There goes my I think I just demonetized now for sure. Anyway, so what happens is when it gets stretched again to the upside, 10% or more, look for a reversal in the VIX and reversal in the market. Same thing for the downside, but in the opposite way. Now, you can see just recently, this recent low we made in the market, the VIX was stretched a pretty good ways away, 20, 30, 40% away. And then notice that the VIX did begin to come down, and then the market still kind of drifted lower in this particular case. Now, I wouldn't rush out and buy a market when it's drifting lower, but when it kind of drifts lower like that, it kind of suggests that it's a little sold out. And then we did have a nice rally off of the lows as the VIX continued to revert back to its mean. Now, one thing I learned from Connor when it comes to volatility, in general, is that volatility tends to overshoot itself. And that's something that you can kind of use to your advantage. So the VIX, when the VIX implodes, it implodes in a big way. And it corrects back to the mean and then usually beyond. Now, what's cool about this particular situation is the VIX quickly became oversold, okay? And I wouldn't have believed it had I not been looking at this chart. And that suggested that we'd see a little bit of a sell-off or some sell-off, right? And we did yesterday, or day before, I should say. And it's still pretty stretched once again. This is the current chart. And so now we're stretched yet again with the VIX. So you can see way down here, about 17% away. And then that's from the moving average. So it's close from the moving average, minus 17%. So even though the market is kind of hanging in there today, the VIX is already suggesting that we could see a little bit of a sell-off back down, maybe go down to the old lows. Who knows? One day at a time, right? But that's what it's suggesting, because there's already this, even though the percentage-wise, the VIX is still high, right? It's at 20. And Connors years ago had some fixed VIX systems where you'd buy above 15 and sell below 10, or whatever the case may be. However, there was a shift in volatility, and then that system no longer worked, okay? So the good thing about the moving average is it kind of adjusts. And I see people talk about fixed levels in the VIX, and for the most part, that doesn't really mean anything, okay? Other than, yeah, the market is more volatile now, and that could be evidenced by many different metrics, of course. But you can see that this suggests, since we're oversold in the VIX, that the VIX is due to bounce back up, and also the market is due to sell off. Okay, just real quick, as I've said before, it only matters when it matters. So when the market gets kind of questionable and kind of crazy, I do pay a lot of attention, or more attention, I should say, to the VIX. High or low, again, is relative. Don't be a hero. You want to wait for that reversion to the mean move to begin to occur. And I wouldn't take position trades off of this. I would take more of intraday type of trades. Now, the caveat is, or a side note is, sometimes you can have a major bottom with a huge VIX spike like we had back in August of 24. Do use it as a gauge for overbought and oversold, especially oversold, because you'll get the really big spike in the VIX, okay? All right, any questions on the VIX? I know I kind of blew through that. I've got tons of stuff on the VIX. You can go to my website, davelandry.com. Then you can also go to my YouTube channel, youtube.com/Dave Landry. All right, just a brief TFM 10% update, and then I want to spend some time talking about the Qs. I'll walk you through the buys and sells in just 1 second. There's the buys and sells right there. There's the rules if you want to screenshot. But again, I'll walk you through them in just one second. So these zones, as I preach each week, Jeff, who's here today, inspired me to add this 5% zone in here. And when the market is greater than 5%, it's in the pink zone. When it's within 5% of the 50-week closing high, it's in the green zone. So as long as it's in the green zone, for the most part, the market's in pretty good shape. It's within 5% of its 50-week closing highs, okay? And by the way, that's why, like in the NASDAQ, we got such a great signal way back here, because the market had been selling off for quite some time in 2023, and the zones begin to drop down. If the market began to sell off a little bit, it would take a while for the zones to catch up to the market, okay? If the market kept going down, it would take a little while. But in a case like this, the sell-off was long enough to where the zones came down to meet the market. Anyway, the sell would be 10% or more away from that 50-week closing high, okay, which we just were at not that long ago. 6114, round numbers, is the all-time closing high, also the 50-week closing high. That's probably why I kept saying all-time closing high earlier. And you have to close below the 50-week moving average. So you have to close below both. Now, since the moving average is above the 10% line, so just a close below 10% is all that's required, but that also obviously puts you below the 50. Anyway, so like I said, since we have a complete trade to take a look at, I want to just rewind for 1 second and show you the buys and sells. The buys are a little bit more stringent. I require 2 bars of Landry light. It's a whipsaw filter, and you have to also be within 10% of the all-time closing high in the light pink zone. So technically, if you were just buying when you're within 10% of the closing high, you would buy on this day here, on this week here, I should say. But I like to have the Landry light filter in there, so you avoid some of the whipsaw. Now, the downside, the idea is to get out quickly to avoid the so-called diaper change moments. But you can see you had 2 bars of Landry light, and you are within 10% of the 50-week closing high. In this case, you're up in the green zone. So if we back this out for a second, that's within 5% of the 50-week closing high, okay? It's really simple stuff. So you have 2 bars of upside Landry light. You would buy on this close, and this is on a weekly calendar basis. It's calendar chart, weekly chart, calendar basis. So your sell signals and buy signals would be on Fridays. And that was not designed intentionally like that, but I decided to just go with it once I realized that I was using a calendar chart and not a weekly chart, or a calendar chart would be Friday to Friday, as opposed to a rolling chart, which would be Monday to Monday, Tuesday, Tuesday, and so on and so forth. Anyway, so you can see there's the 5% zone, the greater than 5% zone, and of course the 10% zone, 10% or more zone. And last Friday, we did get a sell signal because, on the Qs at least, we closed below that 50-week simple moving average. So again, the buy was back here. Again, 2 bars of Landry light. If you back up the presentation, you'll see a zoomed in. That's just a zoomed in piece of that chart that I just showed. And then there was your sell right there. So that was a pretty good run. Now, of course, with trend following, a couple things. Eventually, it's going to end badly, right? It's like buying a pet. Eventually, it's going to end badly, as George Carlin once said. And that's one thing you have to live with. And with longer-term trend following like this, pure longer-term trend following, your accuracy is going to be pretty low, although this trade worked out, obviously. Your drawdowns are going to be abysmal. So there was a 6.4K haircut, thereabouts. I seem to remember an 8K haircut in here somewhere. And then this thing was nicely profitable back here. And had it stopped out, it would have stopped at a loss. So that would have been painful too. Anyway, so like I said before, just for S&Gs, I bought 100 shares on the signal, 319.49. And this is the actual trade. And I didn't realize there were dividends on the Qs. I guess I should have known that. I wasn't really paying attention. But it added up. Let's see, 100, 200, 300, $400 or so of dividends over the period. That doesn't poke in the eye. So you add all that up, take out the original $32,000 investment, and it was 16K overall divided by 31,000. So it's a 52% run. That's better than a poke in the eye. Now, again, the designer's intent, as I've said before, is to avoid the so-called diaper change moments, and that's an Ian McActivey term. Ian's my brother from another mother. He's looking down on us, laughing, I'm sure, especially now. He's probably so pissed off because gold's making these all-time highs or whatever it is. Is it all-time highs? I know we were talking about 3,000 last week, and I think we blew through that. I'll take a look at GLD in a minute, which I haven't looked at futures in a while. But anyway, 52%, that was a pretty damn good run. A couple of random thoughts. Trend following is amazing when it works, and I'm going to circle back to that in just one second. As I've said before, back when I lived in the country, my wife was always, she was very impressed with my handy skills, and I'm pretty handy. I have every tool probably known to man, and if not, I'm going to acquire it. But she was always like, all you got to do is, click your wrench on that pipe, and it'll stop leaking. And of course, 3 hours later and 4 trips to the plumbing store, she walked to the plumbing store once. She threw the door open and goes, "I want 3 of everything that you have in here." She was getting sick of me sending it back and forth. But anyway, she's always like, "Oh, you got to do it." It's like it always looks a little easier on the surface, and that's trading in general. Now the drawdowns are tough. Again, my designer's intent with this was just to get out of the way when the market tanks. And I didn't factor in money management. Now, probably should have said, okay, well, if you're up 20% or whatever the number is, maybe take off some shares or whatever. But I thought it would be kind of fun, and I know you want to part of me, just to follow it completely on a mechanical basis. Now, I don't know if I'm gonna keep following this one mechanically, but I think it would be kind of a good little experiment. But there's gonna be a lot of drawdowns, I would imagine. When you hit it out the park like that, that's probably the exception, not the norm. I guess I'm not selling you on my system, am I? Well, it's free, so trend trades, as I said a second ago, especially longer term trend trades, eventually end badly, and that's why we take a partial profit. It's kind of like that SKBL or whatever that stock was earlier. Had I just bought it and got knocked out on that halt, I would have lost a lot of money on that trade, as opposed to make it a little bit because I took partial profits. Now, I'll tell you this, following a mechanical system, years ago, I used to program mechanical systems. As I've said 1,000 times, I'd wake up early and program for hours, and then sometimes stay at work late and program for hours. And over that period of time, I developed a lot of systems, and eventually it sort of morphed me into a discretionary trader. So it's kind of hard to actually follow this trade. Now, initially it was just 100 shares, who cares? But then it started to add up a little bit. It's like, holy crap, I just lost $8,000 on that last little spill or whatever. Not the last spill. It was a spill that when I just got in it was an $8,000 drawdown, and then $6,500 drawdown in the end, as I just showed you. So it was a little tougher than I thought. Now, I tell you this, on Friday, because the market had rallied a little bit, even though it was still a sell, I'm like, you know what, Dave, why don't you sit tight and let's just see what next week brings and see if it's still a sell next week, okay? And I was like, no, I said I would follow mechanically. I showed this thing mechanically, so I followed mechanically. And here's the other thing too, and it's probably important that this actually happened in the back testing. Luckily, and I don't know if it'll keep working this way in the future, but this system would have kept you out of every major bear market in history. And in 1987, on the Friday before the crash, it had a sell signal. So the chances of the market crashing, like last Friday, I'm thinking like Monday, it's probably not going to crash on Monday, but because I have a signal, I have to follow it just in case it does. I'd have felt like an idiot if I wouldn't have gotten out and the market crashed on Monday. So it's a little tougher than it looks to actually follow a mechanical system like that. All right, any questions or thoughts? Do you look at the VIX when placing a day trade? This is from, is it IJ or LJ? LJ. Lately, yes. Okay. And I back way off on day trading, by the way. You got to be careful in that because, I mean, I have all these screens and you get sucked in to it. My office was so a mess. I turned the camera around. I'm afraid you get some of my crap in here. But like right now, yeah, I would definitely pay attention to the VIX. So when we get to live charts, let's take a look at it and see where we are with it. But definitely like right now, and that might be something you might want to look at is look to buy the markets as a general statement when that VIX is stretched to the downside, whatever the markets may be. And maybe you're looking at some ETFs or something that you might want to buy, like SOXS or LabU or something. And then when it's stretched to the upside, maybe you look to buy the inverse ETFs intraday. But good question, LJ. We'll take a look at that in just 1 second. But if it's stretched, pay careful attention to it and possibly look to fire off a VIX trade and a trade in the indices, or choose your favorite stock or whatever that you like, your favorite ETF. Okay, CJ in the group was talking about how one thing he likes to do is 10 exponential, 50 exponential crossovers. And he was talking about how Tesla had made this big run lower. And this is my reply. When is the keyword in that sentence, trend following works. It's amazing. And taking one step further, or one step behind, I should say, if you look at the original crossing back here, Tesla had an amazing trend higher and then an amazing trend lower, using his metric of 10 and 50 exponential moving averages. Now, as I said a second ago, everything works better with trends. So if we put Landry light in there, then you can see that we had nice Landry light lows greater than the moving average for uptrends and highs less than the moving average for downtrends, okay? And if you wait for about 10 or so days of Landry light, then you possibly have a trend developing, for what it's worth. And you notice in between, the Landry light kind of meandered back and forth, okay? And notice the count never got above 10. And if you look at the chart, and always look at the chart, okay? Whatever your indicator's telling you, always look at the chart. Notice that we kind of chop back and forth. Now we take a look at bow ties, and we look at the proper order, the uptrend proper order and downtrend proper order. And all this indicator does down here, I call them indicators illustrators, right? It illustrates what's going on in the chart. So this is a count of how many days the 10 simple is greater than the 20 exponential, and the 20 exponential is greater than the 30 exponential, and then vice versa for the downside. If the bow ties are crossing back and forth, okay, then it goes to yellow, okay? And you can see that they meandered back and forth. First, we had uptrend proper order, and then downtrend proper order. Now, I'm going to get asked this, and I know I repeat it every week, but this is just a count, just like the Landry light. It's just a count, okay? It does not measure magnitude. So you can see right here, this market began to top out and kind of meander sideways. So even though it did that, the moving averages hadn't crossed back over, so the count continues to increase. Now, it can give you an idea longer term if we have time. Maybe we can take a look at the S&P 500 and we'll see what that Landry light count was with like a 30 EMA. And I think it was pretty amazing with something like a 200. One of you guys were pointing out the 50 or the 200 or something. That was pretty darn amazing. We'll take a look at that if we remember. Somebody remind me when we get to the charts. Downtrend proper order, uptrend proper order, and then in the middle, when it's kind of going back and forth, meandering back and forth, the market itself was going sideways. Now, always look at your charts. Now, with the proper order and moving averages, you're going to have quite a bit of lag. Lag is not always a bad thing. Lag can keep you from chasing your own tail. And that's why I have those whipsaw filters in the TFM 10% system. Now, A word of caution, don't put in too many whipsaw filters or you'll end up curve fitting to the prior data. And as I've said 1,000 times, I've gotten a heated debate with a system designer when I told him that your biggest drawdown is always ahead of you because your system's going to act differently in the future than it did in the past, especially if you put a lot of whipsaw filters in there. So use those very sparingly. Now, of course, the ultimate oscillator is price, right? Just look at the price and use your big blue arrows. We had a nice uptrend in Tesla. We had a nice downtrend, and then we also had some really nice persistency. Persistency is the mathematical equivalent of linear regression. Yeah, the submarine pattern. Yeah, I published the submarine pattern in Twitter a couple days ago, or X. And my X is T following moron. Now, again, if you're just kind of looking at the chart, as I recommend you do, all my initial analysis is done on blank charts before I add a moving average or anything else. And the only indicator I do use is the occasional moving average for the most part. Historical volatility, that's a volatility gauge, so that's something different. It's not a price thing. But you can see we kind of meandered sideways in there for a little while. So the little blue arrow was pointing sideways. Okay, so the point there is everything works better with trend. And the other point I wanted to make is, but YouTube's getting inundated with all these trading systems and all these great and wonderful things. And there's one guy out there, all you have to do is buy on blue and sell on red. That's it. Give me a bunch of money and I'll give you my proprietary formula that does this. Well, I'd be willing to bet, as CJ pointed out with his crossover, if you would have put CJ's crossover on there, or my bow ties, or whatever else, Landry light or whatever, I'd be willing to bet that we could slide our method of trend following over his, and they would line up. One thing you'll find with system developments is all like systems tend to perform the same, even if you're a discretionary trader, okay? So I am a trend trader. I trade pullbacks. And if you're a trend trader trading pullbacks, it's like we might have our own little techniques, but we're probably going to have very similar performance and very similar signals. And they're each going to have their own nuances, okay? So that's one of the points I'm trying to make. Don't get too caught up in some kind of magical formula. I could probably make a lot more money in my educational business if I said I found the Holy Grail and you had to pay me for it. But it's kind of like you've got a goose that lays golden eggs. Would you sell it? No. Anyway, all right. Just real quick, proof of concept with the Landry 100. I do want to show you the way that it kind of shows you where the action is in the market. But all of these were added at brand new closing highs. You can see that one there is up 163%. And the buy, so to speak, was right here. And it's had a pretty good run so far. But the run was much better. Up here was 200, 300%, whatever it was, 200%, I think. And if you go back and watch older presentations, you'll see 100% is nothing, right? You'll see like 200, 300%. We might even have one 400%. But it's a lot harder to find that momentum now. Now, eventually, I think if I was running this as a real portfolio, I'd have a lot fewer than 100 in here now. This is just an experiment. And it's also kind of like a proof of concept with trend, and it allows you to see a lot of different things. And one thing, for instance, is if you take a look at all these, it has them listed as basic materials. I don't know if I can get the subsector in here, but I think every one of these is a gold stock, okay? And there might be some silver stocks mixed in, and they might have a silver component. But what is trending right now? Well, not much, right? The drugs were kind of trending, and I'll touch upon that in 1 second. And now the golds are about the only thing making new highs. Copper's making new highs, as I think Craig pointed out in Facebook. CPER, I think, is an ETF there if you want to look at that. So we might see some copper stocks soon. We could see some gold stocks setting up fairly soon. But these are the gold stocks. And again, these were all added at brand new highs. And they're not setting the world on fire just yet, but this one's up 20%, 13%. And let's see, this one, some of these were just added. Look at that yesterday. Okay, so USAI is already up 13% from just yesterday, I guess, right? Is that the 19th? Yeah. Anyway, so it does help to show you where the money is flowing. Again, momentum ends badly. I think if I didn't do a million little things on know the nuances, I probably should. You really need to understand the nuances of your trading methodology, okay? So when these things happen, yeah, they suck, but at least you're kind of ready for it. It's kind of that, is it negative expectancy, or what was we talked about that a few weeks ago, where you know it's going to end badly, you prepare yourself for that. Like the Stoics would prepare themselves for the day. They're like, okay, I'm going to run into some a-holes at some point today. I'm not going to let that define my day. I'm going to just deal with it. I know, easier said than done. But again, momentum does it badly. That's one thing, the Landry 100. And I really I need to figure out a way to track it in real time. I used to be able to see Stock Charts had another program, or was actually Telechart had another program called, I want to say Stock Finder, that had all that built into it. And that list would get absolutely creamed, like 3 or 4%, which is huge for 100 stocks in a portfolio, right? And I'm like, I don't get it. The market's making new highs, marginal new highs, but new highs nonetheless. And this momentum list will get absolutely annihilated. And lo and behold, nearly every time the overall stock market would sell off shortly thereafter. So there's definitely something there. If somebody has the equipment or the software to do that again, I would highly recommend you do it. And I'll give you the Landry 100 to put in. Relative strength in a bear market is okay, but they eventually find you, so to speak. Now, I'm going to make an exception for metals and mining, okay? Because metals and mining could trade contra to the overall market. What we're talking about here is like defensive stocks, for instance, and I'll show you a chart from last week on that. Because all the major drugs were showing up in this list, and there's still a few left, but a lot of them are getting annihilated lately. So it's like, okay, you kind of go for like the last of the Mohicans in a bear market, but eventually they catch up to them. And one of the myths that I busted in the Layman's Guide to Trading Stocks, which you can get a free copy of, dailyn.com/free-book, I believe. There's a hyphen in there. And if not, check the comments below if you're watching a recording of this. I'll put it in the comments below. But one of the myths I busted is that there's always a bull market somewhere. There's not always a bull market somewhere, okay? Cash is not trash, as I've written about and republished quite a bit lately. And there are no good longer-term investments. Every asset will lose half of its value at least at some point in your lifetime. Now, even though the chasing the RS in a bear market sans something like metals and mining is a bad thing, it still shows you where the money is flowing. So lately, not that long ago, the money was flowing into the drugs, was flowing into the foods, but those areas are getting hit a little bit now too. Anyway, this is left over from last week. I've since taken this one out, but this is Abbott Labs, which is a major drug, and it was making new highs, but unfortunately, it's come right back in. So that's an example of the buying relative strength in the bear market. As a general statement, you don't want to do it.